Welcome to Real Estate with Harmony. My name is Sandra Ziehm, and I'm the owner-broker at Harmony Real Estate on Lowell Road in Hudson. We are going to be presenting a series of shows on real estate and its different aspects. We hope that in the showing you will become more informed and have some of the answers that might bother you regarding real estate. It has changed so much over the years that I've been in real estate since 1972. When I started in real estate, you had 2 papers. Today, when you have a transaction, you'll have that many papers. So it's changed a lot. It's been an interesting evolution, and we hope to share some of those changes with you in this series of shows. Today, I have with me my son, Ken Ziehm, who is the broker of Melody Mortgage, which is an arm of Harmony Real Estate. Our operation is family-owned and operated, even to Melody Mortgage. Harmony Real Estate is also family-owned and operated. So both of my children are involved, 2 of my 5 children, I should say, are involved in the running and operating of Harmony Real Estate. So today we have my son, Ken Ziehm, who again is the broker for Melody Mortgage. I thought that we would start out this series talking about financing, which is very, very complex. And again, when I started in real estate, you had 2 formulas. And if you knew those 2 formulas, you were set. Today, you can't know all of the formulas because they evolve so quickly and change so drastically that it's chasing all day long just to keep up with it. But let me bring Kenny into this conversation. I thought today we would talk about VA loans, FHA loans, and maybe throw in rural development loans. So why don't we start with one that I'm a little more familiar with, which would be VA. My husband and I just went through a process trying to refinance with VA, so I am a little bit more familiar with that right now. But how do you see that as having changed? Have you seen changes in the VA in your time selling real estate, or not selling real estate, selling mortgages?
VA loans are kind of neat. They're wonderful for the veteran because it allows the veteran to come in at a very reasonable interest rate, even when interest rates are high. It allows them to do certain things that they probably wouldn't be able to do with a conventional loan. Specifically, it has no money down. So for 0% down, you can actually buy a house, and you can get the seller to pay the closing costs as long as you negotiate that in order to purchase it, whereas with some of the other ones, you can't do that.
So if I chase the rabbit, I would say to you, are there other loans that you can get with no money down?
There are. The Rural Housing Development Loan that is a true no money down loan, but the difference with that is that it is for a rural housing area.
So there are selected areas that have to be
Correct.
on an approved list of street addresses and city addresses,
Right,
if you will.
and you can go directly onto their website and you can punch in a city street name and an address, and it will tell you whether it qualifies or not, which is kind of neat.
So if you did that, what would their address be?
I believe it's USDA.gov, and you can go through the different screens to find it. But
go to Google and just put in USDA.gov.
www.usda.gov, and then just punch in rural housing or whatever, and it should come up.
So as a general rule, that would probably be true with all the different
FHA.gov, FannieMae.com, FreddieMac.com, all of them are directly on the website, and each one has some pretty interesting stuff to go over.
So going back now to the VA loan that we were going to try to close in on and figure out some of the details. So if I'm hearing you, the biggest advantage to VA is it's no money down.
That's one of them. You can also, in today's world, for conventional loan, you're looking at a 660 credit score plus, whereas with VA, the VA, I don't believe, has a set minimum, although when you go to the wholesale lenders that I would be bringing these loans to, they typically start at 580 plus, but they'd prefer to have a 640. When you have a credit score lower, it starts affecting the ability for that borrower to get a better interest rate.
So you're saying that the interest rate is not set, that the better their credit score, the better the rate they will get?
Credit scores will definitely affect you. Your loan to value affects you, whether it be VA, FHA, or anything else. Your debt to income, with VA, it's a straight 44%. They like to see it coming in so that you're matching up what you earn versus what you pay out per month. as a percentage, and that's how they're coming up with that. But they like to see a good credit score. They like to see you have some sort of collateral, although it's not required. The VA will allow you to ask the seller to pay almost all of your closing costs, and they have certain things that they won't allow the veteran to pay, which is kind of nice because they are looking out for the veteran ultimately. And
I remember when I was young and just starting out in real estate, we actually had VA loans where people walked away with money. They actually walked out with money in their hand after buying the house, which always amazed me. I don't think they can do that anymore, but it was...
they can take back out the money that they put into the contract as the earnest deposit. So if you put $1,000 down in that purchase and sales agreement, you could come out of that closing with that $1,000 down. But you can't get any money out that you did not put in. Same thing with rural housing. The only money you can get out is money you've put in.
So I'd like to go back to the credit score. You said that 540, if I heard you correctly.
580.
580 is the minimal?
580 is
What is the average range of the credit scores?
the average American credit score is about 660.
The average. So, but
Typically,
what's the highest? What's the highest and what's the lowest?
You're looking somewhere around 400 for the low, and you're looking at about 850 for the high.
Okay.
Most Americans are at about 660. The top 10% are at 790 to 800 plus. You don't see a lot, but there's a large disparity between the two.
But we are saying that if they have a better score, let's say they were in that top 10% or 20%, they would probably get a more attractive rate.
They will definitely get some more attractive benefits from it.
And as I recall, if you take a shorter loan, for instance, if you do 15 years as opposed to 30, that will also get you a
The
lesser...
interest rate does typically lessen with that, although it's not guaranteed because, I mean, ultimately the VA is basically guaranteeing through some sort of an insurance with your certificate of eligibility as a veteran that if the veteran defaults on the loan, that they're willing to pay back a certain amount of that loan. And because of it,
There's a fee for that.
there's a fee. There's a funding fee, and that funding fee will depend on whether you're, a full-time veteran, a disabled veteran who may not have to pay any funding fee at all, or if you were a full-time Guard member, and got your entitlement that way. The only way to get that, you can actually have the lender apply for it online. Typically, you need your DD-214, which is a common form in the military that most veterans are aware of. You bring the DD-214, it has all your personal information. You can plug it in as a lender, and you can see if they get a certificate of eligibility. If they don't, luckily enough, we have one right here in Manchester, New Hampshire, that you can go up to and, knock on the door and say, hey, I'm having this problem. I love the people here in Manchester. They'll go out of their way for you.
Oh, yes.
I love them.
I remember that. They are very good. And the DD-214, the certificate of eligibility, if you have, I remember when your father and I first bought our house, it was VA. Then we sold that house, and that was paid off. But if that had not been paid off, at that time, it was my understanding that you couldn't take a second one. You can always, is it still the rule that you can only have one VA loan?
95% of the time, you are absolutely correct in saying that you're only entitled to one VA loan at a time. If you let somebody assume it, there goes your eligibility. There are, in a very, very small number of cases, where you will see somebody get two. Usually it's because they're deployed or because the military has put them in a position that would be unusual for anybody else in the general public. And so for that reason, they might offer them a second VA loan. But generally speaking, what you're saying is absolutely true. You get one entitlement. And when that's used, that's it. Now, once you've paid that off, you are entitled to reuse the eligibility again.
Yeah. So, and going to the funding fee that you were talking about?
Anywhere between 0 and 4%.
It can be
of
up
the
to
loan.
4%. Now, see, in the old days, it was, I remember it being 1%.
Right, and it changes.
Is that average 1%?
I'm not aware of the 1%, I think, but it's changed over time.
So, and maybe for the audience,
all of the funding fees, of the funding fees recently have changed. I mean, I know FHA's funding fees have just changed. So have their upfront, well, they call it a upfront MIP rather than a funding fee. but look at it as a percentage of it. And then the monthly mortgage insurance premium has changed. The nice thing about a VA loan on top of the no money down is there is no monthly mortgage insurance. That's a huge deal.
Yeah,
That's a
that
huge
is a
deal
huge deal.
because, for instance, the FHA has a 1.25% MIP. And let's just say it's a $100,000 loan. That would come out to be a $1,250 cost for the borrower to purchase.
So, people may not know what MIP is.
Mortgage insurance premium.
Okay, just so that they, because I want to be sure they're understanding what we're saying, because it is complex. You really have to.
It still confuses me.
Yes, I think it still confuses all of us, and I just recently, when you are self-employed, it becomes even more complex. And so then you get into where they really dissect the ant, and they want to know everything about everything.
Yes.
Even we
For
are
the underwriter, absolutely.
well, and as you know, we're self-employed, have our own company, and so I recently went through that process, and they not only were looking at me, but they came in and looked at the company with a microscope. So it gets pretty. But you're saying that this insurance that you have to have in order to guarantee that if you default in the loan, they will make good a certain percentage of it. What percentage approximately do they?
Well, there's a funding fee for the VA. They have no monthly mortgage insurance. And the equation that I was trying to correlate it with is that when you do an FHA loan versus or another type of loan that has mortgage insurance monthly, let's say it's $120 a month that they charge you. On a $100,000 loan, you're looking at about $1,250 for the, this MIP, this monthly MIP, but you divide that by 12. So you're looking at about $104, $105 a month that they're charging you in addition to what you're normally paying on top of your principal and interest, your taxes, and your homeowner's insurance. Mortgage insurance premium is in case the bank has a default, and that's what they pay it with. This $105 in today's world, you could probably borrow another $25,000, almost $30,000 as a general guesstimation.
With that funding fee money.
Yes, because of the difference that you're paying. I mean, what could you do with an extra $125, $120 a month?
Your borrowing capacity.
And that's when it's only $100,000 versus a $200,000 loan, which it almost doubles. I mean, just do the math. It's pretty simple. At least it is for me, having done it for a while.
And the closing costs on an average. When I came into real estate, it goes without saying that the closing costs were insignificant. You never concerned yourself. Now it's more than most people put for a down payment. Last time I heard it was like 6 or 7%. Is that still accurate?
As a guesstimation, it's a good guesstimate. FHA allows you to pay up to 6% towards the closing costs. VA limits the number of closing costs that the veteran can pay, which is nice because it makes sure that they're not paying additional fees, that the government never expected them to. And since they're making, government wages at a much lower rate typically as an E1, E2, or an E3, they need to be careful with their nickels and dimes.
We all need to be careful with our nickels and dimes.
With the cost of, with the cost of everyday living. They also do some other neat things, though. They also put in, usually when you're doing a VA loan, the underwriter will ask you to do a monetary budget for the veteran. And it will look everything from child care to, maybe necessary expenses. Maybe that month you had to go out and buy different clothes or whatever. But they also do get...
It's a budget. They do a budget
Sure.
for them.
But they have clothing allowances and, basic allowances for quarters and different things that they get with the veteran, through the government. But until you've done it or until you've seen it, it's tough to believe.
You walk through the process.
Well, I was activated during Desert Storm, and so I've seen what goes on your leaves and earnings statement and what you're actually making. And as I remember, at the end of the day, I mean, I was making $500, $600 a month as an E1 or an E2. Not a lot of money, especially to buy a house.
And that makes me think the minimal, people, in my view anyway, consumers want to know if they make sufficient to buy a house. So I guess I would ask you, what is the minimal income that you could have, in your opinion, to consider going out and purchasing a home?
Depends. Do I have cash in the bank that'll pay for it all?
Let's assume that most
You know?
people don't have that.
Do I have a rich mother? That'll give me a gift?
Let's assume you don't have that.
Okay. It varies. It depends on whether you're buying a condo or the homeowners association fee. It varies on what the taxes are. One city versus another. Nashua's taxes in comparison to some of the other cities around here, for instance, Derry or Londonderry, or if I cross that invisible border into that other,
World.
other named state, which we don't mention. It's interesting because that amount of taxes can affect you just the way that mortgage insurance premium did. It could affect your value of purchasing by $25,000. You might be able to buy a $200,000 house here in New Hampshire, but only $170,000 in Mass, depending on the taxes, depending on the insurance, and the rate that you're being charged insurance. Maybe one company, maybe one city has a higher
I used to
claim.
tell people, of course, we live in a 3-family, and I have found that to be very advantageous because I have 2 other families helping me pay those taxes. Not only that, but I get to depreciate that building, part of the building that I'm not living in, I depreciate, so that gives me another tax incentive. And so there are alternatives. You mentioned condos. Obviously, we now have condos that are in the 70s, probably much lesser than that even. So, and of course, our prices have dropped. I think our prices have dropped as much as 50% since we started into this economic down. I mean, it's been a...
Well, I don't think there's any hard and fast rule. The question you asked was, what's the minimum amount you have to make? I don't think there's a hard and fast rule, but as a generalization, you could buy a mobile home, which is completely different financing than, even going regular, condo or a single family or a multifamily.
I sometimes found that harder though, because with the mobile home, they have a book value much like an automobile. And if it's an older mobile home, some of them they just won't finance at all because of the age, because it's become obsolete.
Larger down payments as well.
Yes, much larger, even for the newer, younger ones.
But they're a great option for some people.
Yes.
There is manufactured housing like Trestlebrook here in Nashua. They have a land lease fee. $344 last time I looked.
Are they
might
down
be a
as
little
low
higher
as even in the 60s?
You'll see them between 60 and 160, depending on full foundation, condition and so forth. Nice little area right here off Exit 5.
Well, they have some that are like brand new, and then
Yes,
they have
they do.
others that
Beautiful
have
little area.
Yeah, have a few years on them, so it makes obviously it makes a dramatic difference. With the multifamily though, they also get credit for income from the tenants.
Yep.
So as in my case, I have 2 tenants, and so they give you a percentage of that to add to your income, which also increases how much you can pay.
They will, but with the veteran or the VA wants to make sure that the veteran is not getting in over their head. So they are allowed to add some money, but they typically want to see that the veteran, if he's getting to be purchasing this large multifamily, there is a point at which they say, I want to see that you've had some experience before. Management experience in processing, landlord-tenant relationships, in handling the tenant, making sure that, the toilet and the bathroom has been fixed, or that, if the heating problem goes on, or something that's going on. They want to make sure that they're not getting that veteran in over their head. And
no, they protect.
Yes, they do.
I remember going back to your comment about the Manchester Veterans Administration Office. They are very committed and concerned to these veterans, and it is a benefit, a long-lasting.
And they have counselors that will go over that with you, which is even better, because some of these people have done these things before, and it's a third party, non-interested in the transaction at all, that you can just go up and ask a question to. They've got no money riding on this. Their only concern is the veteran, which, is the ultimate goal for them.
Well, and the appraisal is part of, appraisals are
Appraisals are completely separate now.
Part of the 6% closing cost, as I recall,
Yes.
that sometimes, like with a multifamily, they're $500-600 anyway for an appraisal.
The last time I checked, the VA appraisal was a lot cheaper than that.
And there again, that goes to the Veterans Administration negotiating on the behalf of for instance, the closers. They go to those people and say to them, can't you cut $50 off of this and give our veteran a little advantage here? And because they represent volume to these to these legal companies, if
Standard
you will.
appraisals now are actually ordered. When I go to a wholesale, it's kind of neat because it's only been a year or two since they actually changed. And the big change was that they've gone to a management appraisal company. These management appraisal companies are basically a third party, a disinterested party, one that will order it. I come in and I punch it in online. It sends the information to them, and then they order it from a list of appraisers, whoever may be next in the line that is licensed here in the
So you
state.
can't, so it makes it objective.
It's an arm's length, absolutely.
It's an arm's length.
Absolutely.
And that is not true with other loans, as I
Well,
recall.
VA has always been like that, at least in the time that I've been doing it, over 25 years. VA has always been like that, and that's why they didn't have some of these problems that, some of the conventional or FHA appraisals
Well, it
have.
seems fair, too, for the appraisers, because you're going to evolve
It is good in many
order.
ways, and it does have some downsides to it as well. In general, they needed it because they were concerned that people were not being honest, and so Mother Government stepped in and said, hey, if we can't trust you, this is what we're going to have to do to fix it. So, it's been good and it's been bad, but it is very difficult now. If you have a small question, I, as the broker, cannot just call, the appraiser and just say, hey, did you realize this messed up or whatever? I have to go through this management company, and then they call from there to there. So I can't just call up,
to ensure objectivity.
my brother-in-law or my best friend who might have been an appraiser before. A lot of the appraisers have been getting a bad, they got a bad name, like everything else. 99% of these people are fantastic. One or two make it bad for the rest of us.
And that's every industry.
Absolutely.
That goes across all lines. You have
Plenty of good appraisers out there that, would, they
and
tell
to
you
me,
the
they don't make a
straightforward
lot
truth
of
no matter
money
what.
for the time they put in. To
No,
be
I would
honest
tell
with
you the general appraisal costs right now have gone up about $100 for standard appraisers because of this new management appraisal system. So it's costing the consumer a little bit more up front, but maybe it's saving them on the back end because now they're assured of a more third-party disinterested company coming and saying, you know what, your house is worth this amount of money. You don't have to worry about whether I'm, going up, and saying it's worth $600 when it's only worth $550. A couple $1,000s here or there, that's a professional opinion, or a difference of opinion.
Well, and I remember having in different lenders, you were actually able to discuss why you disagreed with their opinion.
Yes, you still can.
And on occasion, you could actually get them up if you could support your opinion with documentation.
Yes.
If I could say, look at these comps, they're obviously very similar properties, and they should be in the same price range.
Yes.
Why are you not there? And what I found was disheartening sometimes was they would send in an appraiser who might live in Manchester and send that appraiser to Nashua. I would suggest that Manchester properties, for the most part, are less expensive. But that appraiser coming from Manchester is not necessarily going to know that when he comes into Nashua. So that's one of the things that I think should be considered. And
I
that's
had the exact case in Hudson. The appraiser came in. He basically was from a long distance from here, nowhere close. He wasn't even within 20 miles.
Yeah.
He came in and he took the first 3 comps that he thought were reasonable. But being an expert or somebody that's been living here all my life, I knew a little bit about these 3 comps. One had asbestos, in the ground. One was a foreclosure, and one was in a very high traveled area. And it was that right picture that you took so that you missed the high tension wires in the background, that people are concerned about one way or the other. And because of it, he came up with a price that was $40,000 low. You have the right to say, hey, I disagree with it for these reasons. But it then goes back to that class appraisal, the management appraisal company, which does basically the management of it. And they come back and say, okay, based upon these things, could you review this? And they also sometimes have a field review by a separate appraiser just to make sure that, that the first appraiser might not have missed something.
They were on target.
Or maybe there's a difference of opinion that's not necessarily factual, but more of an opinion, and they can move it around a little bit. But it is very difficult to get that. In the time I've been in, that's the only appraisal I've ever had changed.
Well,
There's been
let's
quite
go
a few.
back. Let's go back to how you qualify and to how you determine what you can afford, because I think
Yep.
that's a good place for people who are wanting to
Sure.
purchase to start, because
They
to
look
have
at
an
your debt
idea.
to income. They look at your credit, and they look at the cash that you have, and they look at your job or an employment
Your
history, you know, because everything they're doing is credit-based risk assessment. The bank wants to know that you are a good or bad risk for these loans, so that they can pool you into separate categories of different types of loans, so that when they sell it on the secondary market, they're selling it to these other companies, and these companies can make a better risk assessment for it. With VA, you're insured for a certain amount of it, so they're less risky loans,
Did
as
we
are most of the
establish
loans.
how much that insurance is now? It was increased, I believe. At one time, it was 17,500, but I think it went up
It
from
is
there.
different, and I do not have an exact figure. You can actually look that up on va.gov, you know, as a factual. And some are entitled to more than others, and some have used some of it. So it will change from veteran to veteran, and I believe it also changes versus based upon your status, active versus non-active, and where you got.
So let's go to the ratios. My understanding is that they have ratios. A certain percentage of your income can go for the debt and a certain amount for the housing. With VA, what are those ratios?
It's typically a straight 44 with VA.
So for both debt, for outstanding debt, as well as principal,
They don't
interest,
do it
taxes, and
as
insurance.
the other companies do it, where you're seeing a front ratio and a back ratio.
They
The
just say
front
one for
ratio is
all.
typically your housing expenses only. And then when you add the other expenses in, credit cards, student loans, car payments, things that revolve, they're going to add those on. And when they go, the front goes that first income ratio, and then the back you add on all those other things in a monthly income, and then they number it out. Typically, you know, on a FHA loan, 29 to 31 on the front is pretty good, and about 43% on the back. The VA would like, they're not as concerned with the front as they are as concerned with the total amount. They like to see it right around 44%. The lower, the better.
So if you made $1,000 a month, it's $440.
Correct. Correct. An average payment around in here, well, I say the average, a beginning payment here in the Nashua area, you know, for a small condo or beginning, you're looking probably somewhere between $900 and $1,200. So if you were to base that upon these ratios, you'd need to make a little over double that, $2,000, $2,200, somewhere around there as a guesstimation. So on a yearly basis, you're making $25,000 to $30,000 with not a lot of revolving debt, such as, you know, I have a $700 car payment. A lot of people get into troubles because they go out and buy a car, or they have student loans that they've just gotten out of college, and, you know, they're not expecting that they're going to have to do it. You
I
know,
used to say to all my buyers, please don't do anything between
Yes.
now and closing.
That's
Please
exactly
stay
right.
at home and watch television and
Yes.
eat popcorn with Kool-Aid.
anything that changes has to be put on the 1003, which is the initial application form.
But I think all of us have had that time when somebody, without thinking, went out and made a major purchase on their credit card, got within a week or 2 weeks of closing,
And
and
they can't
then they
close.
lost the deal because they went and purchased something that threw their debt ratio right out of alignment. So it's really important that you
Making
can't.
your mortgage payment for people that are trying to refinance. I've had people that didn't make their last payment while they're trying to refinance. It's another thing, you know, that you just
Have to have 12 months of payments that have not been behind in order to refinance.
The VA Streamline is nice as well. Typically, they want a 660 credit score, but that's because an overlay of a lot of what these companies are doing from the wholesale lender.
Tell the audience what Streamline VA is, because I think that
A
term would-
Streamline VA loan is kind of neat. Nowadays, the overlays that you're seeing, the VA does not require a lot of things. They don't require an appraisal, but a lot of the wholesale lenders are requiring it
to refinance.
to
we're talking about
refinance
now.
it, because they want to make sure that they're getting a good loan, you know, one that's based upon good risk. They don't want to have a house that's worth $100,000 and they're lending you now $400,000 on a streamline. They want to be careful about that. That's how we got into this problem to begin with.
Yes.
You know, a couple years back. Nowadays, they've tightened up so much that it's making it almost difficult. The value of the VA streamline was that it never had to have an appraisal. But the problem is that we're experiencing disparity in the value versus what it is now versus what they bought it. And so now they're having to lend more than it's worth. And so they're very concerned. Typically,
But
they're doing...
do they do that?
They used to. They currently, and there still may be companies that do. Most of the companies that you're dealing with now are requiring a drive-by appraisal so that they can at least kind of guesstimate, you know, that this is within tolerance, within a tolerance zone of that. Because they're not going to lend you more than 100% of that drive-by value.
As I remember, the VA rate that we were offered to refinance 2 weeks ago was phenomenal. I want to say it was definitely saying 3 and 4%.
Rates
3.5%,
4% are absolutely fantastic.
3.5%, 4%.
Historical lows is the way I would say it.
Historically low, absolutely.
You know, I mean, and the way to look at that, you know, if you're comparing one company versus another, is the APR, based on the TIL.
APR
annual
is what?
percentage rate.
Thank you.
And TIL is the truth in lending. The truth in lending is basically a government thought-up idea that says...
That tells me it's bad.
Well, no, it's actually wonderful because it allows you to compare one loan with
Another loan.
Company A versus another loan with Company B. And it shows you that based upon these costs, this is what loan A is going to cost me, and then this is what loan B will cost me. You still have the right to choose either one you want, but at least it gives you a comparison value so that you can compare one to the other.
So you're saying that if they were shopping for a mortgage company, they could ask for the TIL, truth in lending?
They do get a truth in lending.
And they could ask for it in, let's say they went to 3 lenders.
They can get a good faith estimate, which will describe to them in detail.
And then they could lay them side by side.
Yes.
Because what I remember is that sometimes they would give it to you in one place, but they took it away in another. So we're going to give you 3.5, but then your closing costs, they added all of these costs.
If they add points or discount points or fees, yes.
So you're saying
it's
they
very
could avoid
straightforward.
that.
There's no. As a broker, I have to disclose to you exactly what I'm making. As a bank, the bank is lending their own money, and they are not required to disclose to you what they're actually making in the transaction. As a broker, you have to disclose it. So
the bank does not have to.
They do not currently.
That doesn't seem fair, does it? To me, you know, of course, I'm in politics, so, you know.
How about them Red Sox?
Everything should be transparent.
I think it is transparent because ultimately, it's not transparent in that manner, but it's transparent in another. It's transparent in that you can look at 2 rates and say, okay, these are equal rates. But this is what Company A is charging me, and this is what Company
Closing
B
costs now.
is charging me.
But you have to have the documents to do it. You can't do it over the phone. I think where people get confused is they do it over the phone. And over the phone, they get limited answers. They don't get all of everything, all the costs included. And unless you're looking side by side, identical costs, you know, then you're going to be confused, and you're going to think you're getting a bargain when you really aren't. I tell people, always comparison shop. You know, if you're dealing with reputable people, they will not mind you. I always tell people when I would do real estate,
it's worth it. It's absolutely worth it.
And I would
you'd
say
be surprised
go out
at the differences of one versus the
and
other.
see if they're better, because if they are, then I understand why you're going to them.
Absolutely.
I don't think they are, but
it's
please.
a competitive world. It's
It
an
is a
absolute competitive world, and it
Needs to
should
be.
be that way. You know, cash is green, and you can borrow it, you know, in that
We
manner.
all have to feed our children.
That's exactly right.
So it becomes difficult.
Nothing wrong with it, though. You know, if nothing else, it's good for the education to know what you're going to pay. To be a little bit more informed about the whole process is nothing but fantastic. And I think that's what they intended with the way that they have described this new good faith estimate.
So let's I think we might be giving out of time, and I want to wrap up with just go back and review.
VA.
For people who might be interested in VA. Yep. The rate right now, if they came to your office today, approximately what rate would you be?
I'd be happy to discuss with them at that time because everything is going into it.
Depends on their credit.
But historically low, and if you bring a good faith estimate, I'd be happy to compare mine and let you shop, just so that you can see what's going on. It is true, no money down loan. That's fantastic. It has no mortgage insurance. That saves you a lot of money right there.
So when you do mortgage insurance, like with FHA, FHA has mortgage insurance, doesn't it?
Yes, it does.
So what's their mortgage insurance cost?
That's a 1.25% per year, and then you divide that by 12. So on $100,000, it's $1,250 divided by 12, about $105, $104, $105 per month. And again, that's a $24,000 or $25,000, depending on the interest rate. It could be more or less. But when you tell people,
that's over
when you tell people that they
more
could
you
say
could
they
borrow.
could buy a house worth 25 grand more with a VA loan versus an FHA loan or a conventional loan or any of these other things, that's perfect. There are definitely benefits about FHA that the VA does not have. Right now, to do an FHA streamline refinance loan, there's no appraisal required through many of the banks. So if I did a streamline with VA, I have to do a drive-by. FHA, they've still come back to the thought.
VA does a drive-by, FHA
Yes.
does no.
VA is not requiring it. The VA itself does not require it. The problem is that on the secondary market, when these wholesale lenders sell it to these companies, they're trying to make sure that their credit risk is within certain tolerance. And because of that, they've added these overlays or extra and additional requirements that the VA doesn't quote-unquote do it. Ultimately, these companies are the ones lending it, and so they need to make sure that their investor on the backside, coming from Wall Street or the secondary market, are able to, receive the money that they're being told. Otherwise, they don't want to buy these, whether or not they're insured or not. You can understand that.
Well, and I tell people, if you know somebody in the industry that you trust, trust is earned. You cannot you don't just give trust.
That's right.
Trust is earned. So if you have somebody that you trust, always the best practice is to go with those people you trust, because you know that they're going to be honest. They've proven by their history that they're honest, not by telling you they're. I mean, I can tell you anything,
Right.
but does my walk match up with my talk? And so I always tell people, if you have somebody,
we're required by law as brokers to stick with the good faith estimate that we've given, and there are tolerance ranges that you cannot go above or below. Well, you can go lower, I believe, but you can't go above it. So it wouldn't cost you more.
Ranges.
If I quote you out, that the appraisal is $300, then it has to stay within a certain tolerance level. There are certain levels of tolerance
Can only
that
fluctuate so much.
based upon the good faith estimate. If you don't put in certain closing costs and all of a sudden they start doing it, some of these things will be required that that the broker pay for them if they forget them even. Without redisclosing.
You're held accountable. What a wonderful
Believe
thing.
it or not,
I think it's a good thing.
And some of these, and some companies, not that they're being deceitful, but you'll see them be over disclosed. I would much rather be over disclosed and let you see this is the worst case scenario. Put in a full 12 months of insurance on a refinance, even though we already know that you may have paid 9 months and you may only have to come up with a month or two or something of that nature. At least if you know it's $5 or $6 grand and it comes in at $3,500 at the end, you're much better. And there's a lot of ways now because of the money that they're paying to do these loans, that a lot of these closing costs can actually be paid for in a streamlined refinance, which is nice. Imagine going to a closing cost with nothing.
When you have a first-time home buyer,
They don't know.
Not only do they not know, but frequently what happens to a first-time, they have limited dollars. And so, I have seen people not be able to close for $300.
Yes.
So it's wonderful to overestimate, but sometimes in the overestimating,
Yes.
they could lose their qualifications. So
It
it's
can
a
be zoomed in on.
two-edged sword. It's a two-edged sword. And so sometimes you just have to, and things change as you.
Yes, interest rates go up or down depending on when you
if
locked
it's
or
not,
not.
we didn't even talk about
How
locking the
long
rate.
did you lock? It took me 25 years to learn the stuff that I'm telling you now. And I can't.
Does that mean you're 50?
No, let's just say I'm in my early 40s. But it takes a long time, and you're not going to learn it overnight. It's wonderful if you can sit down with a professional that knows what they're talking about, and he can give you the differences, or she can give you the differences between one loan and another, and why it might be valuable for you versus this one. But if they can explain it to you or educate you on the process, that alone is worth it, because now you're a better educated consumer, so that whether you're even dealing with them or not, when you go to the next person or the next company or whatever, you can look at two loans and say, oh, well, that makes sense. This is how it works, and this is why it works. This is not rocket science. Everything is very simple. This is the cost. This is the interest rate. These are the things that you need to go through. Now, there's a lot of underwriting guidelines that make it very difficult to traverse the maze, as they call it now. But
Traverse the maze?
yes, big word, 25 cents. I'm not sure I can get anything for it.
What do you mean, traverse?
Basically, you're figuring out how these guidelines are being met. And there are ways to look at a loan and send in the right documentation at first. For instance, right now, any large deposits that are made in the last 3 months are basically looked at, because they want to make sure that you're not borrowing the money, or that you're not, being funded by, something other than the money you earned. They want to know where this money's coming from, and that's to make sure that you can afford this loan. So any loan that has, $50 or more, in the last 3 months of your bank statement can be looked at. But knowing these things up front, are wonderful. So you want to make sure that when you're trying to go and get a loan, that you're not, not setting yourself up for failure in the long run. If you're going to get a gift, or you've gotten a gift from multiple people because you got married, or you had a birthday or whatever. I get 20 checks for $50 each. Well, now how do I prove that? I'm going to have to go back and make sure. So you may want to plan. There's a lot of little details.
How long does the money have to be in the account so that they don't have
They're
to go
going to-
back and verify where it came from? 6 months?
You typically on most loans that I'm looking at, we go back 3 months on your bank statements.
Okay. So if the money's been there longer than 3 months, they
They
won't.
typically do not go back
they don't
after
document where it came
but they
from.
do. They they're not looking to have you go around the rule. They're looking for you to say, this is what I've done in the last 3 months, as an indicator of what you normally do, and then you kind of go from there. But typically, you're going to be seeing at least 3 months.
Well, we didn't get to FHA. We didn't get to the rural development loans. But
25 years and 30 minutes. Love it.
well, it is a complicated subject, but I hope that you'll come back with another show and we can go further into this complex. It is very complex, and it's hard to put your arms around it, but we'll certainly try, and hope you'll come back for another show so that we can do that. Thank you for visiting Real Estate with Harmony.